the Fed can tighten until a couple things start to happen. We start to get outright recession. We start to get outright, kind of broken credit markets where just, credit markets freeze. No one's able to bring new debt to market, refinance existing debts. And then, finally, treasury market freezes. Basically, the dollar spikes so much. The banking system's not able to buy treasuries. The foreign sector's not able to buy treasuries. Tax revenues are falling because the economy is not growing and asset prices are not going up. So they have to issue more treasuries. And when that kind of kicks in and they start to actually get outright liquidity problems in the treasury market, it's kind of checkmate. And so they have to reliquify markets in some way.
In an inflationary period, the go-to response of the U.S. Federal Reserve is typically to raise the federal funds rate, which is the target interest rate at which banks borrow and lend out money. This usually has a ripple effect across all sectors of the economy, sufficiently slowing down the markets until prices fall. Typically, it takes 1 year or more for a change in the benchmark rate to have a widespread economic impact, but for the stock market, the reaction is almost always instantaneous. Higher interest rates mean higher borrowing costs. So when the interest rate increases, people spend, consume, and invest less, sucking out a lot of liquidity from the financial markets. This fall in demand causes inflation to fall. A great example is what happened between 1980 and 1981, when the Federal Reserve raised interest rates to 19% to bring down the 14% inflation. Of course, this plunged the economy into severe recession, but it helped bring down the double-digit inflation. 40 years later, and the central bank is using the same tactic to bring down the near double-digit inflation. While there are many similarities between what is happening now and what happened then, many economists are certain that the Federal Reserve will not be able to continue raising interest rates indefinitely until they get a handle on inflation. In a recent interview, Lyn Alden, the founder of the Lyn Alden Investment Strategy, gives her opinion on interest rate hikes and quantitative easing. Alden explains that over the past decades, a lot of debt has been built into the system. With almost all the sectors of the economy so reliant on debt, she adds that the Federal Reserve will have no choice but to retrace its steps when the economy declines further. We will now take you to Lyn Alden's interview. But before we do, please take a little time to like this video, subscribe to the channel, and don't forget to drop your comments and observations in the comment section below. Thanks, and enjoy the video.
So I think ultimately they're not going to be able to normalize that it's both politically untenable, but then even it just becomes a certain point mathematically untenable. And so I generally view the idea that we're going back to normal, we're gonna have like a period of austerity to be it's somewhat delusional in the sense that they kind of basically it's kind of this based on premise that when you have inflation, look, now you have to raise interest rates, you have to get back to positive real rates, and my contention is that due to decades of kind of bad policies and deliberately creating more credit and deliberately being stimulative and lower interest rates over time, we've built up so much debt in the system that is reliant on those low rates. And that's at the household sector, it's at the corporate sector, it's at the public, the federal sector. And so all these debts rely on the premise of super low rates. And then ironically, kind of passing that on, tax revenues rely on asset prices going up and the economy growing, substantially in nominal terms. And so when that machine starts stopping, right? So when you start to harden the underlying unit, and basically you don't have money supply go up anymore, and you start to get higher structural rates, that whole thing grinds down a lot faster, I think, than people realize. I don't think a lot of people realize just quite how financialized and how reliant each thing is on the thing before it. Basically, it's turtles all the way down. And so, to use my prior, description, if they could just raise rates and get us back to normal, that kind of assumes that, the government at 130% debt to GDP is going to be able to pay positive real rates structurally going forward, and that, corporate balance sheets and that household balance sheets, that everybody can absorb positive real rates on a long-term basis without sort of getting all these liquidity disruptions and just outright depressionary conditions. And then it assumes that there's no feedback loop. So what happens when you try that for a couple of years? Because we can certainly try it for periods of time. We're obviously in the middle of attempting it. When you start trying that, you start to get those negative feedback loops, and then the people that are trying it end up getting voted out of office because everybody's miserable. And they want to try something different. They don't even necessarily know what they want to try differently. They just, whatever this is, we don't want this anymore. Let's vote for the other guy. And so they go the other guy. It might not be better, might be worse. Who knows? And if that's bad, then they go back. No, we want the other guy again, right? They'll whatever's not working, they'll vote for the other thing. And so that's why it's usually hard to maintain that kind of downward spiral. And so the way I would describe this is the Fed can tighten until a couple of things start to happen. We start to get outright recession. We start to get outright kind of broken credit markets where just, credit markets freeze. No one's able to bring new debt to market, refinance existing debts. And then, finally, treasury market freezes. Basically, the dollar spikes so much, the banking system's not able to buy treasuries. The foreign sector's not able to buy treasuries. Tax revenues are falling because the economy is not growing and asset prices are not going up. So they have to issue more treasuries. And when that kind of kicks in and they start to actually get outright liquidity problems in the treasury market, it's kind of checkmate. And so they have to reliquify markets in some way. And so we're not at that part yet for a couple of reasons. One is, obviously, there was so much liquidity in the market that you can suck a good chunk of it out, and that takes time to actually get back to a breaking point. And number two, right now, because of prior year's good tax revenues, and because, in quarter two and quarter three, there's not a lot of net treasury issuance. This problem is not really being marked to market right now. We're starting to see cracks in a couple of these markets, but nothing's kind of totally broken yet. But I think when you go out to say 2023, and if you were to kind of stick in this period and keep pushing asset prices down, by that point, the treasury market is, the treasury has to come out to market and issue a lot of new treasuries because they're going to have a wider deficit. They're not going to have this current period of, relying on last year's good tax revenues. They're not going to have that behind them anymore. And so that's when I think you start to see kind of that feedback loop break down, right? So there are these kind of hard limits on the system that eventually prevent them from continuing to tighten. And I think that's the thing that the market maybe doesn't fully realize.
Lyn Alden is no doubt an intelligent economist with lots of great ideas about a lot of things. In this short clip, she has raised a lot of important issues that investors should be considering. One is the debt issue, which was grave even before the interest rate hikes. In addition, everything boils down back to politics. Policymakers are really dedicated to maintaining the false everything is good image even when the economy is literally going up in flames. To continue to uphold that image will mean they, at some point, have to re-inject money into the economy and continue to prop it up. They prop it up for a few more years, everything looks good, and their successors inherit the problems and basically just recycle the whole process. What are your thoughts on Lyn Alden's interview and the next path for the Federal Reserve in bringing down inflation? Please drop your comments and observations below, and don't forget to like this video. Thanks for watching.